Hey everybody, Bernie Garland. Name of the program is the IRS Fix, brought to you by the Garland Group. I'm Bernie Garland and tax attorney Tim Berry. You all know him because you've seen him before. Hey, I want to talk about 4 concepts.
Okay.
First concept. First one? That's very good. First concept.
Went to law school to do this.
Year-end tax planning, estate planning, charitable gifts, and gifts to your children. Can you speak intelligently on all of those?
Sure, they're all the same concept, really. At the end of the day, they're pretty much the exact same thing. What Bernie's talking about is December 31st is looming large. It's coming up really fast. And in order for you to make completed gifts for either the tax donations for a charitable contribution or the gift tax savings for the kids, you've got to make those gifts completed by December 31st. Is that what you were talking about,
That's
sir?
what I was talking about.
Okay, and so why would somebody want to make a gift to charity, for example, besides helping out their favorite charitable cause?
Let me see, would a tax deduction be appropriate?
Tax deduction. So you can get
Wow.
all sorts of tax deductions by making the charitable contributions. But here's the big thing. Bernie, the other day, what we were talking about, the key thing for people to do whenever they're making charitable contributions.
To make sure that they get the tax deduction and the other people get the tax consequences.
Very profound. To make sure the individual giving the gift gets the tax deduction and the other people get the tax consequences. Now, what's Bernie mean by that? Am I going to translate or are you going to explain it?
No, what do I mean?
Well, here's the
Well,
thing.
let me ask you a question.
Yeah?
If I have $100,000 in stock,
Yep.
and my basis that I paid for it is $50,000, Tim, I can sell that stock, and then I can give that $100,000 to the charity. Is there a better way to do it than that?
Yeah, because if you sell that stock, you're going to have a tax hit of probably about $7,500. Roughly, depends on a bunch of different situations, but let's say that's going to cost you $7,500 in taxes. If instead you just give the stock itself directly to the charity, you don't get hit with a tax bill. The charity, the nonprofit, the tax-exempt entity gets hit with a tax bill, and since it's tax-exempt, it doesn't have to pay taxes, and you still get the same $100,000 deduction. So that's the better way to give to a charity, is by giving appreciated assets to your favorite
And
charity.
this all has to do with tax planning for the end of the year and any other year that you may want to. Now, what about giving dollars and dollars and dollars to your children outright? How much can you give to your children each year?
Well, you can give to the kids each year about $14,000, and I say about using the weasel word about because that's indexed for inflation. 2015 is coming up. It may or may not go up at that point in time. But each year you're allowed to give each person who you want to $14,000 without there being a gift tax hit. So if you're married and you have one kid, husband and wife, $14,000 each can give $28,000 to their kid. If they only have one kid, if they have 2 kids, that'd be $56,000.
Tax free.
Tax free, gift
Yeah.
tax free.
Yeah.
No income taxes either.
Think about this for a minute. If you gave that amount to the children on 11 p.m. on December 31st, and can you give the same amount on January the 1st, the morning of January the 1st?
Absolutely could. What a great stocking stuffer, huh?
Well, but here's the problem. Those children may go out and spend all that money, and mom and dad may want that. However, what about if mom and dad wants to make that gift, the non-taxable gift, but want a little control over what the children can do or not do? What happens then?
It's all about that key phrase, control versus ownership. What mom and dad could do is they could set up a trust, put the assets into the trust, gift the assets into the trust for the benefit of the kids, use up that gift tax exclusion, and yet mom and dad can still control the trust, be the trustees of the trust. So if the kids go out there and do any of the stuff I did as a kid, mom and dad can yank the money right back.
And is it fair to say that you have done this in some of your family matters?
Well, Bernie, it's really funny you say that, because here's the thing is, if you set up the trust properly, it's taxable to the kids. I have a daughter who doesn't live in the People's Republic of California, and so my daughter has certain assets inside of a trust for her benefit that is not subject to taxation in California now. It's a wonderful thing.
It goes back to what we said at the last podcast. What we advise people to do, first of all, is totally legal. And second of all, we implement our own plans. We implement all the information that you're getting today has been implemented by our staff and the principals involved here. So it's a good thing, isn't it?
You Martha Stewart?
And Martha Stewart is a good thing. It's better than Lois Lerner, isn't it?
It is, sir. It is.
Anyway, with those words of wisdom, I think it's what we call it, a wrap.
Well, we're talking about gifts, aren't we? So it should be a nice little bow and
we
wrapped
put a
up.
little wrap and a bow and everything. Anyway, you have it. It's legal. It's tax planning. It's year-end tax planning. It's estate planning. And it's gifting to children, non-taxable, and also in a way that if you want, it could be controlled and yet have the tax situations that are favorable to you. So, Tim, until next time, we got that gift wrapped. There you are, folks. It's a wrap.
Thank you,
Bye-bye.
everyone.